capital budgeting. I will continue in this video itself. After explaining the risk analysis, we will be winding up the capital budgeting portion. So what is risk analysis in capital budgeting? See, so far we had studied capital investment, initial capital investment or present value of cash outflow is there for a project, and CFAT is there. Okay, a present value of cash inflow is there in a project. So there is investment in a project and a return is there in a project. These are the two things which we study. So these are the two things which we study. Investment is there and return is there. While taking the return, when we take some statistical tools and adjust the risk involved in it. See the risk, what is the risk involved in a project? Any project, we will get the return in future only, isn't it? 2020, we have capital of 50,000 crores. We are investing in various avenues. We may get the return in the next 5 years or 6 years, or it may take more years and then only we will get the return. So what is the risk involved? Time value. Because of the time value of money, the rupee value may deteriorate. That is a risk. Default in projects may happen. Okay, failures in project may happen. The present situation like epidemic situations and total economic financial failures may happen. Economic risk is there. So in order to avoid that risk, the return will be adjusted with the risk using some statistical method that is called risk analysis in capital budgeting. There are various methods of adjusting the risk. How we will adjust? We will include the risk factor in the return. So return is adjusted with what? Risk factor. So return we are taking into consideration with the risk, that is risk analysis in capital budgeting. This risk plus return is what we will compare with initial investment. So the return is compared with the risk. Return is compared with the risk and we are comparing with the initial investment. That is all about risk analysis in capital budgeting. There are various methods. One is probability analysis. We will find out, for example, if 50,000 crores we are investing in a project, first year we are getting 10,000 crores. So we will find out what is the probability of getting that 10,000 crores. Is it 0.5 or 0.6 or 0.7 or even 0.1? So that probability portion, using statistical method we are taking, that is probability analysis and the risk analysis in capital budgeting. Sometimes we may take risk adjusted discount rate. We may quantify the discounting rate along with the probability of risk. It is called as risk adjusted discount rate. Another method is that best and worst risk estimate is there. Best and worst estimation. We may take the project return based on the best possible year or the best time and the worst time. For example, if before the COVID period, nobody might have estimated that this type of lockdown period may happen. This is the worst estimation. That estimation we have to predict. In the sense, we have to estimate the bad times may also come. So what will be the return that we will calculate? Best time, what will be the return according to industry cycle or the project life cycle, etc. We will find out the return and compare it with initial investment. That is best and worst return approach. Then there is something called OPML approach. That is optimistic, pessimistic and most likely approach.